Open any retail trading platform today, and you will almost certainly be greeted by the exact same default layout, a brightly colored candlestick chart. It is the absolute baseline of modern market participation. But this visual layout was never intended to be a digital financial tool. It was created centuries ago by rice merchants as a way to track physical commodities moving on carts. If you step off the retail platforms and walk onto a professional floor, look at quantitative desks, or shadow veteran operators, you find a very different environment. These environments heavily reject the retail standard. Instead of thick colored blocks, institutional operators overwhelmingly favor traditional, minimalist OHLC bars, standing for open, high, low, and close. This leaves us with a highly practical question. If candlesticks are universally accepted by the public as the best way to read price action, why do the most advanced data traders completely ignore them? The answer comes down to cognitive programming. The layout you choose for your terminal dictates how your brain processes risk, making this a critical UI/UX decision that directly impacts your execution success. To understand why professionals use different tools, we have to look at the screen as an instrument of visual telemetry. This simply means measuring how an operator receives and processes real-time structural data. In high-pressure environments, graphic design alters a human's risk perception. The shapes and colors on your screen dictate whether you remain calm or feel pressured to act. This split-screen comparison matrix evaluates both methods using the exact same dataset. We are looking at them strictly through a UI/UX framework to measure their signal-to-noise ratios. Adding a scorecard for cognitive load versus data purity gives us an objective baseline to see exactly what each layout demands from the operator. The left side uses heavy visual weight and color to evoke an immediate emotional reaction. The right side is entirely sterile, presenting nothing but a mathematical matrix. Ultimately, choosing a chart architecture requires a strict trade-off. You sacrifice the visual comfort of pretty patterns in exchange for total cognitive sanitation. Look closely at this macro close-up, isolating a single candlestick next to an OHLC bar. The core difference is immediately obvious: the shaded real body. That thick visual footprint exists solely to map the distance between the open and the close. Now look at the OHLC bar. Those exact same open and close data points are represented entirely by two minimalist horizontal pegs, the open on the left, the close on the right. The thick body provides an immediate trade-off. It allows for instant pattern recognition, but it creates a massive amount of visual weight that easily dominates the entire screen. During a volatile session, staring at massive sequential blocks of color forces your eyes to track erratic movement, leading directly to physical overstimulation. Thick green blocks act as visual hooks. To an operator, that much visual volume creates a sense of urgent momentum, often leading to impulsive entries at the very top of a price move. Conversely, thick red blocks dominate the screen. The sheer size of the graphic makes a downward move feel physically larger than the data suggests, which can trigger an exit before the price even hits a stop loss. By stripping out the colored bodies entirely, the OHLC bar relies on neutral data lines. Removing the color bias completely helps keep the operator's physical heart rate significantly flatter, even during the most volatile market swings. The candlestick's body overweights the open-to-close range. It creates an optical illusion that draws the eye inward, making it harder to maintain clinical detachment. This visual isolates and highlights a different part of the anatomy, the absolute extremes of the session, commonly known as the wicks. Because the candlestick body carries so much visual weight, it actively obscures the wicks, making the extreme high and low of the session look like secondary details. On the OHLC layout, the entire session is represented by a single continuous vertical line, showing you the exact range of volatility from top to bottom. Without a fat body blocking the view, this minimalistic anatomy forces those high and low boundary extremes to become the primary visual anchors on your screen. Seeing the precise vertical range allows operators to deploy a tactic called one-tick invalidation. They can set their risk parameters exactly one tick past that raw vertical boundary. Compare that to the standard retail experience. When operators are biased by the thick visual body of a candlestick, they frequently place sloppy stop losses, often ignoring the true structural extremes. Removing the colorful body definitely creates a steeper learning curve, but in exchange, it allows you to spot where the market actually stopped with zero visual obstruction. Retail traders are traditionally taught to identify market absorption by memorizing complex, multi-candle patterns, hunting for specific shapes like engulfing bars or dojis. Relying on these visual shapes treats the chart like an art project. It introduces subjective interpretation into what should be a strict analysis of price levels. This flowchart tracks the specific distance between the closing right peg and the extreme bottom of the OHLC's vertical range line. When the closing peg prints at the absolute dead bottom of a wide vertical range, it's an objective signal. It means the market stopped moving lower exactly where it closed, indicating that all sell orders were cleared out at that price. Because the right peg is isolated, you can clearly see this exhaustion of orders at the edge of the range. It removes the ambiguity found in a thick candle body, making it easier to identify when price hits a level and holds. Reading a raw matrix this way requires discipline. You have to completely abandon your reliance on emotional color blocks to tell you what the market is doing. By translating visual narratives into clinical structural intelligence, the OHLC bar acts as a cognitive shield for the operator. We have evaluated the UI trade-offs. Now it comes down to applying this framework to your specific requirements as an operator. This quadrant chart maps an operator's specific trading style against the visual layout that best supports their goals. If you are a casual investor or rely on narrative setups, your needs fall into this discretionary sector. For this group, standard candlesticks are an acceptable choice. However, if you are a day trader, an algorithmic system operator, or react impulsively to price movement, you operate in this systematic territory. For this systematic group, visual comfort is a liability. It must be traded for mathematical detachment to ensure the system is executed without emotional interference. For those who need to eliminate bias from their process, the OHLC bar layout offers a structural advantage that standard candlesticks cannot replicate, aligning the visual tool with the need for clinical accuracy. We can analyze the theory of UI architecture all day, but the only way to test this is to apply it directly to your terminal. I want you to execute a 1-week visual detox. Go into your settings and completely switch your layout from candlesticks to traditional OHLC bars. Expect initial friction. It will feel uncomfortable when you lose the color-coded emotional narratives you are used to seeing on the screen, but push through it, and you will force your brain to stop hunting for visual hype. Instead, you'll start identifying pure structural levels and daily equilibriums. Actively monitor your reaction during a volatile session. Notice how maintaining a flat physical response allows you to manage your risk with clear logic, instead of reacting to the size of the blocks. So, execution mastery requires insulating your parameters from cosmetic noise. Turn off the visual fat and start operating on precision coordinates.